Here is a claim in investing that sounds like it should be impossible, and yet is one of the most well-established, mathematically provable ideas in the entire field. You can reduce the risk in your investment portfolio without giving up any of your expected return. This sounds wrong. Every other corner of investing operates on a basic trade-off. If you want a higher expected return, you generally have to accept more risk. And if you want less risk, you generally have to accept a lower expected return. This trade-off is so fundamental that it underlies nearly every other concept in this entire field. And yet, diversification, specifically combining investments that do not move in perfect lockstep with each other, genuinely breaks this trade-off under the right mathematical conditions in a way that is not a trick, not a sales pitch, and not wishful thinking. It is a mathematical certainty, provable with the same rigor as any equation. And it is the specific insight that won its discoverer, the economist Harry Markowitz, the Nobel Prize in economics. This is why diversification is widely described across decades of finance literature and education as the only free lunch in investing, a phrase meaning precisely that it is the one place in this entire field where you can get something, lower risk, without giving up something else, expected return, in exchange. This video explains exactly how this mathematical trick works, the one specific number that determines whether combining two particular investments actually produces this risk reduction benefit or does nothing useful at all. A real, settled Canadian historical example that shows exactly what happens when this principle is ignored, and precisely how to apply it practically using nothing more sophisticated than a single low-cost Canadian ETF. If you want to keep your money mindset sharp and learn how to make your capital work for you, consider subscribing to the channel and liking this video. It truly helps the channel grow and teach people about financial education. Now, let's get right into today's breakdown. To understand why diversification is a genuinely free lunch, rather than simply a vague, generally good idea, you need to understand a specific, important distinction between two fundamentally different kinds of risk that exist within any individual investment. Idiosyncratic risk, sometimes called unsystematic or company-specific risk, is the risk that is specific and unique to one particular company, asset, or investment, arising from factors that affect that specific holding and generally do not affect other, unrelated holdings. A company-specific product failure, a fraud scandal at one particular firm, a key executive departure, a factory fire affecting one company's specific manufacturing operations, or a lawsuit targeting one particular business. Systematic risk, sometimes called market risk, is the risk that affects the broad market or a wide swath of the economy simultaneously, arising from factors that, by their nature, affect most or all investments at the same time. A broad recession, a significant interest rate change, a major geopolitical event, or a widespread shift in investor sentiment that moves prices broadly across many unrelated companies and sectors at once. Here is the critical insight. Diversification can substantially reduce idiosyncratic risk, but it cannot reduce systematic risk. If you hold a single company's stock, you are exposed to both that company's specific idiosyncratic risk and the broader systematic risk affecting the entire market. If that one specific company experiences a product failure, a fraud scandal, or any other company-specific catastrophe, your entire investment can be devastated, even if every other company in the broader economy is performing perfectly well at the exact same time. If you instead hold shares in many different, sufficiently unrelated companies simultaneously, the idiosyncratic risk specific to any single company becomes increasingly diluted as you add more holdings, because the company-specific bad news affecting one holding is statistically unlikely to be perfectly mirrored by identical bad news affecting every other unrelated holding, at the same exact time, meaning the portfolio's overall volatility from this specific source of risk decreases as diversification increases, even though each individual holding's own expected return, considered on its own, has not been reduced in any way. Why this distinction is the entire foundation of the free lunch. Idiosyncratic risk, by definition, does not come with any additional expected return compensation, because it can be diversified away at essentially no cost simply by holding more, sufficiently different investments, meaning an investor who holds a single concentrated stock position is bearing a specific type of risk, idiosyncratic risk, for which financial theory holds they are not being additionally compensated, since that same risk could have been eliminated through diversification without sacrificing any expected return. Systematic risk, by contrast, generally is compensated with additional expected return over time, precisely because it cannot be diversified away, no matter how many different holdings you add, which is why investors require a return premium for bearing it. Your action step: for any individual stock you currently hold or are considering, ask explicitly, is the risk I am taking on with this specific position primarily idiosyncratic, specific to this one company, or systematic, shared broadly across the market? If it is substantially idiosyncratic, recognize that you are bearing a type of risk that diversification could eliminate at no cost to your expected return. Here is the vault from the opening. The one specific number that determines whether combining any two particular investments genuinely produces the risk reduction free lunch or does almost nothing useful at all. It is called correlation, and it measures the degree to which two investments tend to move together, expressed as a number between -1 and +1. A correlation of +1 means two investments move in perfect lockstep. When one goes up by a certain percentage, the other goes up by a proportionally identical amount, and vice versa on the way down. Combining two perfectly correlated investments provides essentially zero diversification benefit, because they behave, for risk purposes, as if they were really just one investment held twice. A correlation of zero means two investments' movements are statistically unrelated to each other. Knowing what one did in any given period tells you nothing about what the other did. Combining investments with correlations at or near zero produces meaningful, genuine diversification benefit. A correlation of -1 means two investments move in perfectly opposite directions. When one goes up by a certain amount, the other goes down by a proportionally identical amount. Combining negatively correlated investments produces the most dramatic possible risk reduction benefit, because the movements of one investment directly offset the movements of the other. Why this number is the entire key to whether diversification actually works. If you hold 10 different stocks, but all 10 happen to be highly correlated with each other, for example, 10 companies within the exact same narrow industry, all affected by the same specific industry-wide factors, you have achieved the appearance of diversification, 10 different names on a statement, without achieving the actual mathematical benefit, because their shared high correlation means they still tend to rise and fall together as a group, largely failing to diversify away each other's idiosyncratic risk in any meaningful way. Genuine diversification requires combining assets whose correlations are meaningfully below 1, ideally across different industries, different geographic regions, different company sizes, and in some portfolio constructions, different asset classes entirely. Equities combined with bonds, for example, which have historically exhibited a lower, sometimes negative, correlation during certain market environments, covered in this channel's other videos on portfolio construction. A simplified illustrative calculation showing the actual mathematics at work. Consider two hypothetical investments, each with an identical expected annual return of 8% and an identical individual risk, standard deviation, of 20%. If these two investments have a correlation of +1, moving in perfect lockstep, a portfolio combining them equally still carries a combined risk of 20%. No reduction whatsoever, because there is nothing to offset. If these same two investments instead have a correlation of 0, the combined portfolio's risk drops to approximately 14.1%, a substantial reduction, while the combined portfolio's expected return remains exactly 8%, completely unchanged. If the correlation were negative 0.5, the combined risk would drop even further, to approximately 10%. This is the literal mathematical demonstration of the free lunch. The expected return in every single one of these scenarios remained identically 8%. Only the risk changed, and it changed specifically and predictably as a function of the correlation between the two assets combined, proving precisely that risk reduction, under the right conditions, genuinely does not require sacrificing any expected return. Your action step, before assuming a portfolio of many individual holdings is well diversified, explicitly consider whether those holdings are meaningfully different from each other across industry, geography, and company size, or whether they are, in practice, highly correlated variations on a similar theme, providing the appearance of diversification without its genuine mathematical benefit. This is not a hypothetical. Canadian financial history provides one of the most stark, well-documented illustrations of what happens when idiosyncratic risk is not diversified away, and it remains directly relevant to understanding this principle regardless of how many years have passed since it occurred. The historical record, presented as settled fact, Nortel Networks was, at its peak around the year 2000, one of the largest and most valuable companies in Canada, and at one point represented over a third of the entire total market capitalization of the TSX Composite Index, meaning a very substantial proportion of all the value held across the entire Canadian stock market was concentrated in the fortunes of this single company. Many Canadian investors, including many holding the company through employer pension plans, individual retirement savings, or direct stock ownership, held significant, often concentrated positions in Nortel specifically, frequently as a result of its sheer size and prominence within the Canadian market, making it feel, at the time, like one of the safer, more dominant holdings available. Following the broader dot-com market downturn of 2000 to 2002, combined with company-specific issues, including an accounting scandal that emerged in subsequent years, Nortel's share price declined by over 99% from its peak, and the company ultimately filed for bankruptcy protection in 2009, with its remaining assets sold off, and the company ceasing to exist as a going concern. Why this is specifically an idiosyncratic risk lesson, not simply the market went down. While the broader dot-com downturn, a systematic risk affecting the entire technology sector and much of the broader market, was a real factor, Nortel's decline of over 99% versus the broader market's significant but considerably less extreme decline over the same period reflects substantial company-specific, idiosyncratic factors layered directly on top of the systematic downturn. Specific accounting and governance issues, specific competitive and execution failures, and specific decisions made by that one particular company's management that were unique to Nortel and not shared by the broader market or even by other technology companies that survived this same period. The diversification lesson this illustrates with complete clarity. A Canadian investor who held Nortel as one small position among dozens or hundreds of other sufficiently unrelated holdings experienced this specific company's catastrophic decline as a minor, contained event within an otherwise intact and continuing portfolio. A Canadian investor who held Nortel as a large, concentrated position, a genuinely common outcome at the time, given the company's size and prominence within the Canadian market specifically, experienced this same event as a devastating, in some cases, life-altering loss of a very large proportion of their total invested wealth. The broader, generalizable principle this specific historical example demonstrates: no single company, regardless of its current size, prominence, or perceived stability at any given moment in time, is immune to the possibility of severe, company-specific decline. This is true regardless of which specific company, sector, or era is being discussed, and is precisely why the mathematical case for diversification, covered in segments 1 and 2, is not merely a theoretical abstraction. It is a principle with direct, demonstrated, real-world consequences for Canadian investors who failed to apply it, and direct, demonstrated, real-world protection for those who did. Your action step. If any single individual stock currently represents a meaningfully large proportion of your total investable net worth, a common and understandable situation for employees who have accumulated significant employer stock or stock options over time, explicitly consider the Nortel example as a concrete illustration of the specific, uncompensated risk that concentration creates, regardless of how stable or dominant that company currently appears. This segment translates everything covered so far into the specific, practical question every investor eventually asks: how many holdings, and what kind, actually constitute enough diversification? And what is the simplest way to achieve it? The diminishing returns of adding more holdings within a single market. Academic research into diversification has long demonstrated that the benefit of adding additional individual stock holdings, all from within the same single domestic market, diminishes meaningfully after a certain point. Commonly cited research suggests that a substantial majority of the idiosyncratic risk reduction benefit available within a single market is captured within the first 20 to 30 individually selected stocks, with additional individual holdings beyond that range producing increasingly marginal further risk reduction, because at a certain point, additional holdings within the same market and economy begin sharing enough common systematic risk factors that further individual stock selection provides diminishing additional benefit. Why this matters for the practical decision between individual stock selection and broad ETF investing. This research finding is precisely why a globally diversified, low-cost ETF, holding not 20 or 30, but thousands of companies across multiple countries, sectors, currencies, and economic conditions simultaneously, represents a more thorough, more complete, and dramatically less effort-intensive application of this same diversification principle than attempting to individually select and continuously monitor even a reasonably large number of individual stocks. The Canadian practical application, XEQT as a maximally diversified single holding. XEQT, the iShares Core Equity ETF portfolio, covered extensively elsewhere on this channel, holds approximately 9,000 companies across global equity markets, spanning the United States, Canada, international developed markets, and emerging markets in a single ticker, at a management expense ratio of 0.20% per year. This single ETF diversifies not only across thousands of individual companies, addressing company-specific idiosyncratic risk as thoroughly as is practically achievable, but also across multiple distinct geographic and economic regions, providing some additional protection against systematic risk that is specific to any single country's economy. Even though global systematic risk affecting all major economies simultaneously cannot be diversified away by any portfolio construction, across industries and sectors, and across company sizes. Why this represents the practical conclusion of everything covered in this video. A Canadian investor holding XEQT has applied the mathematical free lunch from Segment 1 and Segment 2 about as thoroughly as is practically achievable for an individual investor, has avoided the specific, devastating concentration risk illustrated by the Nortel example in Segment 3, and has done so through a single purchase requiring no ongoing individual stock selection, monitoring, or correlation analysis whatsoever. The entire mathematical apparatus covered in this video has already been built directly into the fund's structure by its index methodology. The honest limitation, stated explicitly, even maximal diversification of this kind eliminates idiosyncratic risk as thoroughly as practically possible, but it does not and cannot eliminate systematic risk. A globally diversified equity portfolio will still decline meaningfully during a genuine global recession or broad market downturn, because that risk, by its very nature as established in Segment 1, cannot be diversified away through any combination of holdings. Diversification is the free lunch specifically for idiosyncratic risk. It is not, and was never claimed to be, a free lunch against all forms of investment risk whatsoever. Your action step. If your current portfolio consists of a relatively small number of individually selected stocks, calculate explicitly how many distinct, sufficiently unrelated companies you actually hold, and compare that number honestly against the thousands of companies held within a single diversified ETF like XEQT to assess how much of the available genuinely free risk reduction benefit you may currently be leaving uncaptured. Let's come back to where we started. You can reduce risk in your portfolio without giving up any of your expected return. A claim that sounds like it should violate a fundamental rule of investing, and yet is mathematically provable. Won its discoverer a Nobel Prize, and is widely described with good reason as the only genuinely free lunch in this entire field. Now you understand precisely why and how this works. Idiosyncratic risk, the risk specific to any one company, can be substantially diversified away by combining sufficiently unrelated holdings, and because that specific type of risk does not come with any additional expected return compensation in the first place, eliminating it through diversification genuinely costs you nothing in terms of expected return. Systematic risk, the risk shared broadly across the entire market, cannot be diversified away no matter how many holdings you combine, which is precisely why it remains compensated and precisely why diversification was never claimed to eliminate all investment risk whatsoever. The specific number that determines whether any two particular investments actually produce this benefit is their correlation. And genuine diversification requires holdings that are meaningfully different from each other, not simply numerous. Nortel Networks stands as a real, settled, sobering Canadian illustration of exactly what concentration risk costs when it goes wrong, regardless of how large, dominant, or seemingly stable a single company appears at any given moment. And the practical conclusion is almost anticlimactic in its simplicity. A single, low-cost, globally diversified ETF like XEQT applies the entire mathematical insight covered in this video about as thoroughly as is practically achievable for an individual Canadian investor through one purchase, requiring no ongoing individual stock selection or correlation analysis whatsoever. Diversification will not protect you from every form of risk that exists in investing. But for the specific substantial portion of risk that it can eliminate, entirely free of charge in terms of expected return, there is no good reason to leave that benefit uncaptured.